Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope I am audible to you. Let me display the PowerPoint presentation. So, it is a special webinar today. In FX Trade, they identified a topic, news and events trading. They asked 6 experts to give their ideas how exactly during the time of the news release or during the event formation, how exactly one can read the market and take advantage in their trading. And normally the traders ask several questions during the news release time. In FX Street, there are webinars as well as in the home page you come across the chat forum, where as soon as the news is out, people tend to ask the expert whether euro will go up or whether euro will come down and what sort of trade one can do. And this is the normal scenario or a question you come across. And you find varied answers are given. Some say that let the market settle, then probably you can identify the trend and enter into the market after looking into that of the supports and the resistance. And certain others say that the market might make volatile moves. You develop a different idea and try to trade depending upon the type of moves which are happening in the market. And invariably you find that it gives enormous nervousness and the uncertainties to that of the traders. So we need to read the pulse of the forex market during the news release time and the events which are happening in the market or in the world. And the events are pertaining to that of the economic conditions of various countries, and the news can be of varied nature, and it can be the news from that of the government or from certain agencies, etc., and which could be in the form of a breaking news, an unscheduled news, or a news which is expected to be released in a specified time. And similarly, the events like economic data release and also the speeches. And especially when the speeches are there with regard to the government agencies, you find the market speculate. Either way, they expect some announcements, and if the expected announcement is not coming through, they react variedly, etc. Then the prime decisions like the rate decision, interest rate decisions, and certain other decisions with regard to the policies also give the reactions to that of the market. So basically the market needs the trigger, and in order to gain the momentum, and these events and the news act as the prime source of such triggers. And also, besides that of the economic conditions and the news, you come across the natural calamities like tsunami, etc. When there is such natural calamities like volcano eruptions, and that can also influence the economic conditions of the country. As a result, the market could derive a different perceptions, and as such, you might come across sudden variations with regard to the market perceptions. Or then you come across certain prime announcements made by the governing agencies of the respective countries, and also the rating agencies like S&P 500, S&P, and also other rating agencies. They try to give the rating as a surprise breaking news, and that also triggers the market. And this sudden change can bring in the market sentiments, and the momentum can vary accordingly. The momentum in the sense, suddenly you will find the spikes on the upside or on the downside, and everybody will be looking around and trying to ask the other persons in the chat forum or with regard to the experts, etc., what happened to that market. And invariably you find that those who have been following the market news by getting the news feeds and reading the Reuters feeds, etc., they might come out and say that this is the trigger, because of that euro has come down or euro has gone, this sort of thing. So invariably you find the market needs the triggers, because otherwise the market will be lackluster. At the same time, these triggers can really give knee-jerk reactions to that of the market, and suddenly the market triggers can change the market perceptions. So when the market triggers are of varied nature, which is of the news driven or the fundamental economic events or the natural events which could trigger the market, and invariably you come across the knee-jerk reaction, and suddenly you find a false move followed by that of the intentional move happening. Suppose euro has to drop for the news, and you find that quickly it gains the level as if the news is positive to euro, and everybody will be questioning why euro is rising when the data is negative, and suddenly you'll find that it's dropping. So the traders would have expected euro to drop, but it will not drop just like that. It may make a false quick upward move and then drop. And this sort of pretension is bound to happen in the market. And during such pretensions, you find the traders develop uncertainty. And because the traders fail to understand what is the purpose of that upward move, and then followed by that of the downward move. And the traders might think that, okay, it is negative to euro, and obviously euro is dropping now, and they develop the sentiment and try to sell. Then after selling, they realize that they are the last ones to sell in the market, and the market started gaining the levels. And when they look around and ask and search in the websites and also in the forums, why suddenly euro started rising? And you might come across a reply that somebody has spoken that US economy is not that good. So immediately you find that the market reacted to such speech. So you find invariably the market is being triggered by various such events, and then the market gains the momentum, and people say that the market has to move based on the fundamentals. But you find invariably when the market moves against the expectations of the fundamentals, people might give the comment that it is a technical rally, and fundamental driven market is being changed or it is being triggered by the technical conditions. As a result, the market has reversed. So for every event trading and the news trading, you come across this sort of volatile moves, an expected move followed by that unexpected move. So the market continues to give surprise to that of the traders. So when the traders change their sentiments and think that, okay, euro has to drop because the eurozone condition is very, very bad, and suddenly they find euro started rising after they take the position, sell positions, and then they are forced to do the short covering of the positions, and later on think that, okay, the eurozone crisis might be over or overdone, so let me take the buy position in euro. Probably euro could go up, but later on he finds that euro started dropping. So invariably the trader feels that it is next to impossible to read the market. Then he looks for statistical analysis and try to look for the supports and the resistance and also retracement concepts, etc., and try to apply as many conditions as possible in order to understand the market. But the market continued to change the sentiments from time to time, and it could be a short-lived sentiment like an intraday sentiment, and when the next news event comes out, the earlier one would have been forgotten, and the people might be talking about the next news event. And sometimes the news or the sentiments could be a long-term sentiments, and like the eurozone now the sentiments, and it could be a long-term sentiments, and people expect euro to go to 1.19 or 1.16 and things like that, but it is not dropping that much. It has dropped from 1.35 to 1.23 and subsequently hovering around. What is holding euro? So that is what people used to think. So invariably there is no quantification with regard to the impact of the news or the events. So nobody will be able to say that, okay, if there is non-farm payroll data release, there should be 100 pips up or down move. And if it is a breaking news, probably market should make 50 pips downward move and 50 pips upward move. So nobody will be able to quantify it in terms of the pips. And also it might be related to that of euro, but still GBP might be falling. And they say that because of the market sentiment, even GBP started falling. It might be data related to that of GBP, but still euro might be falling. And so this sort of conditions continue to operate in the market. So people need to understand how to decide on the trading. So there you come across the traders' expectations and during the data release time. Normally you come across every website or the prime websites in Forex, you come across the data release schedule is given in the form of Forex calendar. And in the calendar you come across that there are scheduled data release like the weekly reports and the monthly reports of the indicating economic trends of using various parameters, and they're all the indications to find the consumer price index and things like that, or the consumer sentiments. And this sort of data are being released from time to time on a weekly and a monthly basis, like unemployment claims, etc. And when such data are being listed in the form of a Forex calendar, you find that in a day there are so many events the market has to pass through. Then the market expectations and the actuals are also given in such calendars. So you find the market is expecting a positive data and the actual may differ, or the actual may be in line with that of the expectations. There are two possibilities. And for that, the market is expected to react based on the past experience. When, say for example, non-farm payroll, when it is negative, then they expect euro and GBP to go up as the USD weakening move. And you know that last month non-farm payroll, when it was released, and euro and GBP started coming down in the month of May. And when people asked, they said it is the risk aversion. So what is being not thought of, or what is not being expected of, might be given in the form of a market comment. Then besides, following that of the data release, you come across the high expectations with regard to the scheduled speeches. So non-farm payroll in US is very poor. What is going to happen with regard to US economy? Everybody expects Mr. Bernanke to come out with some solutions. So whenever you find that speeches are being highlighted, you find that might be given in red mark and things like that. You will be talking in some forum or addressing some meeting and things like that. But still, they expect something to be announced. When the announcement is not there, immediately you come across a different type of reactions. And besides, you come across also unscheduled speeches. When the market goes to the extreme levels, suddenly you might come across a release that the government could intervene when it is unhealthy to the economy. So you find that just a speech about intervention can bring in the reverse in the market. So how the traders could find when somebody is going to speak, when unscheduled data are going to be released, or when such parameters are going to be highlighted in the media and other places. So such breaking news really change the trend, and the traders really get caught. And many traders think that, okay, it is better to avoid during such data release time. Let them release all the data, let them understand fundamentally how the economy is, and later on we enter into the trade. By the time they enter into the trade, there may not be any move at all, and probably it might be 10 to 15 pips move on the upside and the downside. They become frustrated. Everybody is interested to capture the profit during such news release and the events, but unfortunately they are not in a position to perceive what could happen in the market. And when they are not able to perceive, they expect the experts to perceive and tell them. That's what happens every time. But my concept is a trader needs to become an expert, and he has to read by himself so that he becomes responsible for his trading. And also he get convinced that this is the right trade. I'm trying to do it during this news break or even trading. So how exactly that perception can be achieved? So let us go into the details of it. Suddenly a currency pair may look very cheap or a high priced. When euro was around 1.28, people were thinking after seeing 1.30, 1.28 was very cheap. And then later on, when euro started coming down to 1.26, when they have seen the supports are around 1.22, then everybody was telling that euro could settle around 1.22. So totally the market perception changed. And when it went up to, came down to 1.2290, it started gaining in a very big way after a downward stop. And a person who has decided when euro was around 1.2526 that okay, when it comes to 1.22 or 1.23, I should buy. That is the decision he has taken, and he was not interested in entering into the market before that. But when the actual level has come, he became jittery, he became uncertain, and he was confused. Probably euro could go to the next support level of 1.19 and then probably reverse. So it is looking like a falling knife. Why should I catch it and let them settle and consolidate and start showing the green candles and an upward move, and later on let me enter into that of the market. So you find that even though the trader has perceived that after the drop it should have the value to buy, but after the drop, when the actual drop happens, he becomes uncertain. So the market is bound to give the uncertainty and bound to give the surprises and bound to show the trading decisions and the market perception are wrong. So when euro is around 1.26, when you think that it could probably go up to 1.27, it comes to 1.2555. So how exactly we have to perfect the market perception? This is another real question. And besides, you find there are certain days wherein you find the data release is at very frequent intervals, like sequential release of the data. So 8:30 GMT there will be a data, 9 GMT there will be a data, and 12:30 there will be a data release, 13, 14, and 15 like that, and 18 GMT one speech. On the day you come across so many releases, and such sequential releases happen. Now, for example, 7 GMT today, S&P was expected to announce the interest rate, and there was no change. And you find the market hardly reacted to that. Then 8:30 GMT, the data was there, and even though that was considered as a prime data release, but market has not reacted. But 9 o'clock GMT, probably I'll just show the today's economic calendar. So this is the economic calendar from FX Trade. You find that the data which are given as a prime importance, like 3 asterisk and things like that. So when you find that every time S&P rate decision was 0, then afterwards 8:30 GMT, 8 GMT, then Switzerland SMC financial stability report, and they are not bringing much of an expectation, much of a change in the market. But suddenly when it comes to 9 GMT, even though which was considered as a less important data, we find that the market started reacting. Euro and GBP started coming down. So you find invariably there are so many data released in a given day. Then added to that, you come across speeches. King is supposed to speak around 18 GMT. I think in the other list you come across. Okay. This is the economic calendar from Forex Factory. Here you find that some data release which are shown in red and some in orange of lesser importance and things like that. And later on you find that 18 GMT there is a speech from Governor King of which could influence GBP. So throughout the day you come across so many data to be released, and in between you come across only very few gaps what the market can do. Let me go back to my PowerPoint presentation. So when there is a sequential data release, the market waits for the traders to commit positions. If the traders are not willing to commit positions, thinking that there could be further trigger to that of the market, and later on we could enter into that of market, let them settle all the release, then later on we think of entering into the market, then the players also wait in the market making subdued moves, and then later on you find that one of the event which is released might give the trigger and euro might go up before the next data release. Immediately he feels that he has missed that opportunity and look for an alternative. Either do a sell and buy trade after the rise, or look for a breakout trade, buy after the rise so that the market could go up, and then book profit before that the next event comes around 12:30 GMT, which influence euro to drop. So invariably you come across the volatility happen in the market, and sometimes you find even data release such as the BOE and the ECB interest rate decisions on the same day. Hardly you come across any move because everybody is waiting for ECB press conference. So you find when the sequence of data are there, then the market is not bringing in much of a volatility. And this volatility is very essential for trading. If the market is static, not making any move, there is no point in trading. So it has to make volatility, but the volatility we are not able to understand when exactly it is going to happen or when it is going to start. Whether the event or the data release is going to be used for such trigger, or the moves are going to be later on or before that. So it is a never-ending story. So traders may come and go, but the market will go on forever like a brook reacting to the news and events. And in such a scenario, if you want to be a smart trader, you need to develop the idea how exactly during such news release one will be able to capture the profit quickly and rest of the time take rest and look for another data release time and try to enter into the market and book profit quickly and just take rest. And that sort of condition will really encourage the trader to be patient, wait for such data release time, capture the volatility, view the volatility as a good trading opportunity and try to earn money from that of the market. So you find that various country news and events continue to pour into that of the market, and they give alternate stimulus. Say for example, when the data is from euro, if it is negative, from eurozone, if it is negative, we expect euro to drop. And later on around 12:30 GMT, when the data is coming out of US, which is negative to US dollar, then you find euro started going up. So what was perceived as a negative impact over that of euro around 8:30, which is totally changed because the US data is also negative, so euro started going up. Because we cannot exclusively trade US dollar, we have to trade it as a cross between US dollar and euro. So invariably when US dollar comes down, euro goes up. So that sort of alternate stimulus comes from various countries. And adding to that, you come across even the data from Australia and Japan, Asia, Europe and Middle East, then afterwards UK, US. Every data is being taken into consideration. Now it has become the style throughout the world, and every even small country started releasing the data in order to bring in the trigger to that of the stock market, etc. So you find it has become a story forever. So the data release, the fundamental data release is going to be the story forever here afterwards, and even the small countries. And with regard to stock market and the release from that of the companies also play a vital role, and they also give alternative stimulus that of the market. So sometimes you might come across the global sentiments, and that can influence the stock market all over the world to fall. Then the local sentiments which could trigger the market to go up. So you won't be able to assess whether the global sentiment is stronger or the local sentiment is stronger, which way the market is going to move, either on the upside or on the downside. But we need to understand one thing: the market has got a very short memory. But unfortunately, we have got a stronger memory. But the market has got a very short memory. So a news event or a news can surpass the old one just a matter of 2-3 hours. If there is a data around 11:45 GMT and 12:30 there is another data release, then 11:45 GMT data could give one sentiment, and the sentiment can be totally changed by 12:30 data release. So it has got a very, very short memory. If you think that 11:45 GMT data is going to have an impact for the day at least, you might be disappointed. So ultimately, we have to understand the data release time and the news time or the market trigger times. And every trigger need not give the expected moves in the market. These two things are very important. Every time news and news events are discussed until the next news or the events come up, they are all market comments, and when the change happens, we find it extremely difficult to change our mindset. By the time you digest the new discussions and things like that, another change comes in. And you know that euro is trading from 1.2450 to 1.26 in this fashion. About 50 pips up, 50 pips down, and then up and then down alternatively. People are really restless, wanted to know whether euro or GBP can really go up, or they are going to be sideways forever. This is how the market is going to be. That is how the questions prevail in the market. A smart market reading before and after the news are very important. First of all, it is a man-made market. So in the man-made market, we need to understand that there are big players who trade against the herd of traders. The herd of traders go with that of the market sentiments, and the big players create the market sentiments and act against that of the traders. So what they do is, in order to stun the traders, they make quick moves at the spikes in the market, and they are all false moves. Why there is an urgency to buy euro when it was around 1.25 to rise it up to 1.26, as if there is going to be an enormous scarcity of availability of euro. Then you find that euro goes up to 1.26, stays there for throughout till US session. Then people think that tomorrow we should be able to see 1.27, 1.28. But next day they show 1.25. This is how they stun the traders. And the traders think that, okay, it is going to that of the resistance, so we could sell, but it breaches the resistance and goes above and stay there. Then immediately people think of, okay, we have to wait for the next resistance and then only we can sell. But they don't go up to that of the next resistance and start coming the next day, telling a different story. On Monday, you know that the Spain problem was solved, and the bank problem in Spain was solved, and immediately you saw that euro opening with 100 pips upward. And throughout the day you saw that euro was sliding. And then later on the comments came that people are not very happy with it of the solutions what is given and things like that. They are all nothing but interpretations. But who made that quick rise? It is a false move. And why they made the quick rise? Because they wanted to gain the levels and book profit with regard to all the buy positions. You know that news was positive to euro, so everybody was free enough to buy euro at 1.26, 1.2669, things like that, thinking that it will go because the problem is resolved. Then They say later on, no, it is not resolved. People are not happy with that. And there are a lot of strings attached to that. So they started making the slide. Then Tuesday they thought that, okay, there could be further news which could trigger the market. But euro started coming to 1.2450. And people thought that, okay, the eurozone crisis is not resolved. Euro has to drop. Now you find euro has gone back to 1.2559 and 69 and things like that. So they continue to stun the traders by making alternative moves. And especially, bringing the stunningness is very easy when they breach the psychological levels like 1.26, 1.25, 1.24. When they make such moves, breach the psychological level, which invariably triggers the fear. And most of the time, such spikes and things like that are being done. And we think that it is because of the news. No, because the traders have developed the sentiments that euro is weak and it has to fall. So built a lot of sell positions. So the players quickly gain levels, induce the short sellers to do the short covering and turn long when they breach all the resistance and go above and stay. Then the traders think that, okay, euro fall is over, the bottom is in and they have to go up. Then the traders go and buy. The next day they give some other relation or some other reactions to that. So this is how you find alternatively the traders continue to become stunned. The brain is not in a position to think, or the mind is not in a position to decide whether we have to exit out of the loss making position or whether you have to book profit in a profit making positions. And when such moves quickly happen, a person who is holding a profitable trade might think that it could go further up, so let me maximize the profit. Then the next day he sees that the position is making loss. So out of greed and the panicness, the traders continue to loiter around in the market without any clue. And they attach to one expert and later on find that this expert is of no use. We have to go to another expert. Endlessly they search for the experts to give, but fail to recognize there is an expert in everyone. And if they recognize the expert in themselves, then they will not be surprised and they will not be stunned and they will be able to do meaningful trade. So those holding positions before events become distressed and cut loss when they find that it becomes very nervous. The market could react very sharply to that of the news. Afterwards, you find that I could have held the positions. Because of these conditions, you find predominant of the traders trade without a stop. That is the only reason the traders trade without a stop. Everybody knows that the equity has to be protected. But if they keep the stop, then invariably the stop is filled. Afterwards, the market moves as per their expectations. So they keep the stop. And when the stops are being filled, the equity is eroded. They come to the conclusion, here afterwards I should trade without a stop. Because nobody wanted them to be indisciplined. And because of the bad experience, the traders choose the easiest way of trading without a stop. But the players have got another tactic of earning the money from them, namely margin call. So if they lose a few trades and later on decide not to keep stop and keep very less equity and hold one position, let me just earn out of that during such spike. But what happens? They make the move in one side on the downside about 150 to 200 or 300, 500 pips. Margin call attracts. Once the account is closed, they blame somebody. Okay, because of you, I was holding the long position. Because of you, I was holding the short position, but I lost my account. This is the third account I have lost. No, I am not going to give up. So let me open another account. This broker is bad, so let me open a trading account with another broker, thinking that the other broker might be mercy enough. But no broker is going to be mercy because they wanted to earn money for themselves. So ultimately, wherever that opportunity comes, they will give the margin call and close that account. So those who enter the market after the news events look for technical support and the resistance, and many times exit very quickly or miss the profit booking during breakout trades. because of such volatility. So euro, when US non-farm payroll data is weak, so they expect euro to go up. So euro might make one knee-jerk reaction on the upside, then started coming down. Then they think that, okay, I have to book profit, otherwise it will be a great risk. Then later on you find euro goes up in a very big way. So they are not able to withstand the volatility. So how this has to be tackled? So the only solution according to me is watch the quick moves. What sort of moves they are doing during different sessions. And we have to understand in the market, if you want to make money, you need to be cunning. So what sort of cunningness can be seen in the market? It is very simple. The cunningness can be seen in the form of a stop hunt. So if it is a downward stop hunt, before the data release, like 8:30 GMT, there's going to be a data release, or 12:30 GMT, a data release is expected. So around 8 GMT, they make a downward stop hunt or an upward stop hunt. They make a downward stop hunt around 8 GMT during the session start time. Then they will be hovering around in the middle level, and then exactly before 8:30 GMT, they will make a dip. If they make a dip, it will appear as if they are going to make a downward move, breaching the 8 GMT low. But they may go closer to that, and after the data release, suddenly shoot up. And we have to find out what is going to be the next data release. If there is a 12:30 data release, and the spike upward could last only for about 30 minutes. So up to 9 GMT, they will gain the level and stop cutting the new high for about 30 minutes and start building sell positions. And around 12:30 GMT, they will make a drop or hold around in the middle level. And 12:30 GMT, they may make a small firming up. So a move before that of the data release is a false move. Around 12:30 GMT, if the data is going to be released around 12:25 to 12:30, they will quickly gain the level. After 12:30, suddenly they will make a drop. So the stop point will indicate what way they wanted to make the moves and where they are going to stop it. If you find euro is going from 1.25 to 1.26, if you think that euro can rise unlimited in a given day, then that means you have not understood the market. It has got its own limitation. They can gain about 100 to 150 pips. They have done already the gain. On Monday, you know that straight away during start of the Japanese session, they have gained about 130 pips. If at all they want to gain another 20 pips, they can gain on that day. If you evaluate it, then you will not take long position after the gain. So we need to understand that what are the limitations and how exactly they play cunning with us, and read their cunningness. It is very simple. Read their cunningness. And if a stranger comes to your place, when you are walking along the road, comes to you and say that, sir, something has fallen on your shirt, can I remove it? We ask, what is the interest he has got? So we have to question that. And he is a stranger. If he is a known person, fine. He is a stranger, he is simply willing to extend help. And if you think it is a genuine help and you focus on it, your purse might be missed. So you have to understand why he has shown such courtesy. So here in the market, the stop hunts, they will pretend as if the market is going to drop very quickly and suddenly reverse. And these things can be easily understood if you use the live market quote page. But if you look into that of the candle, unfortunately what happens, the session changes are not being displayed in the candle. And also in between the sessions, the gap times are not shown. So you find that the market is a continuum. But every session, depending upon the traders' long and short positions, they alternatively make moves. And they use the data and the news release trigger time just to make their own moves. And there is no need or a guarantee that they have to make the moves in line with that of the expectations of the market. If all traders have turned long, expecting the non-farm payroll is going to be very weak this time, and when the data is released, it might be dismally poor, and you all expect euro to jump, spike, but they may just make about 10 to 15 pips upward move, start making the drop. And every news feed and also in the TV, media, everywhere and websites, you will find market finds risk in holding euro. So risk aversion is seen, market started offloading euro positions. That's all. So all are holding long. The players are not courteous to give profit to such traders. So ultimately the news and the event are used as excuses by that of the players, and they are used as a trigger time, and they make their own moves. If you understand that and move after the news or the events and moves before, you'll be able to understand. The first stop and will be the opposite of the move they intend to make after the release of the data. So this cunningness is a cunningness for several years. I've been watching it from 1996 and associated with FX rate from 2001. And I've been telling the same story from 2001 that before the data release, they make the false move, and still they have not changed it. And opposite intentional move is seen after the data release. So according to me, identify their cunning moves and try to take positions. And you know that there was a release in FX rate from 2007 ITC conference till now. Those experts were spoken in the ITC conference. They were all contrarian traders. So they don't go with that of the market sentiments, and they read it differently because they have perceived it, and probably they have not explained it openly, but they know very well that the market is nothing but a place wherein the cunningness play a vital role. So you have to identify the cunningness. You should not become victim to that cunningness. So they drop market, and you will think that, okay, this fellow is simply telling every time buy and sell, whereas the market is continuously dropping. But we need to understand, if the traders are not cutting the positions, long positions, and trying to hold, the next alternative for the players is to drop more quickly, so that those who are holding long positions out of margin fear cut the positions. Then afterwards you find euro is not going to 1.19, instead it has come to 1.26. This is what happening every time. Then if traders want to enter after the data release, understanding the outcome, you find the market becomes lackluster. And you might come across, as I explained, USD weakening move after the data release. You may come across a risk aversion move wherein USD might be gaining. And everybody may say that USD is the safe haven. Gold is the safe haven. So the safe haven status will change from one place to another place, or one currency to another currency, one commodity to another commodity. You may not be able to keep all your wealth from one to another so quickly, but that is how they present it. And you know that once you go to the bank and ask them to convert all your gold and keep it in US dollar, it will take time. By the time they will say gold is the safe haven. But you cannot convert and go back, because they would have taken the commissions, the pip variations with regard to the conversions. So there are practical difficulties, but you find the news feed will continue to say that risk aversion, risk appetite, USD gaining, USD weakening, Eurozone crisis, Spain crisis resolved, and again the crisis coming in. So every time, 24 hours, you will bound to listen to such news, and ultimately the trader's decision is vital, and that is going to give you the profit. So just keep aside all the events and just note down only that data release time and the events release time. Besides, there are unscheduled data release, and unscheduled data release, nobody will be able to protect you other than the hedging order. So if you use the hedging order to limit the risk, then if they suddenly make a move and after a sudden breakout news, then you will be able to protect yourself or close it with a hedging with a limited loss when there is a drastic move happening in the market. So we have to understand that nobody can help in our trade other than ourselves. All can give ideas, including me, but if I take the position, I have to assume the responsibility to close it with a profit. And if you ask somebody, and somebody may not be knowing my conditions, how much of equity I have, and what platform I am using, whether I have the hedging facility. So unless and otherwise the conditions are known to others, they are not going to give the appropriate solutions. So during such quick false moves, before the data release, you try to enter. When they make a stop and you buy. And when they stop cutting the new low for more than 30 minutes, then wait for the data release and they will definitely make a move opposite to that of the downward stop. And if they have done it on the upside in first 30 minutes to 1 hour after the data release, quickly exit when studying the new high. Don't aim or don't expect them to make further rise here, because they know very well when they make quick rise, all the traders who have gone short will cover the short and turn long. That is the trader's psychology. When the traders turn long at a higher level, the players are not there to give them the profit. They start making the drop. So just enter, note down the data release time, enter during the false downward or the upward move. If it is a downward move, buy. If it is an upward move, sell. Near that of the high set, you try to sell. Near that of the low, you try to buy. Don't look into that of the numbers. And those numbers, if you compare it with that of the previous number, may look expensive or cheap. It may technically look different. But you just identify the move, and if they stop cutting the new low, today's low, for example, 1.2543, they have formed, and they have not stopped cutting it for the past 30 minutes after the data release, and they made the drop, and they are bound to make the rise afterwards. So this way, if you try to take position and still to protect, use the hedging order to limit the risk and keep stop at entry once the position makes profit, and trailing the stop during that of the upward spike, your stop will close it very quickly when they start reversing the position, reversing the market. So that is the only way technically you can do trade and maximize the profit during such quick moves in the market. So understand the sentiments are short-lived. Don't go by that of the sentiments which are created. Okay, you have a sentiment, fine. This is the sentiment prevailing in the market. Okay, fine. So the players are here to act against. Look for such action. So when the sentiment is downward in the case of euro, don't look for small trade like I sell it around 1.2555 and book profit around 1.2545. Then when you try to enter trade like that, if you fail to book profit when the sentiment is changed, you are trapped, because you are bound, you have developed that tendency to trade without a stop. Then it becomes a vulnerable trade. So because you may not have time to keep stop during scalping. So understand all those things. When the market is dropping, don't try to do the sell after the drop. And when the entire drop becomes visible, when you are selling, nobody questions when I am selling. No, you're not aiming that market to drop further down. Who is buying there? If you question somebody is buying, is he a fool to buy? Then you will be able to understand they are the players. They drop and induce the traders to buy, sell, and they buy and quickly make an upward spike and exit out of the positions. Very easy. Because of the higher volume, they are able to really dictate terms in the market. And small traders cannot do anything other than reading their pulse and try to trade along with them. And also you may come across in the market, if a data is pertaining to that of euro, then other currencies might be making the moves opposite to that, or ahead of that. So you may come across the data might be pertaining to euro. Yesterday, for example, GBP data, GBP was not rising, but euro was making nearly about 100 pips upward move. And later on, after the GBP data, GBP started gaining. So that way you will be able to see the other currencies move ahead, either showing the USD weakening or the USD gaining moves. So my idea of trading decision could be, when they make quick moves, understand they are false moves, and they quickly drop buy when they stop cutting the new low for more than 30 minutes or the new high for more than 30 minutes to take a sell position. And don't be bearish or bullish in the market, and for small moves of 30, 50 pips or 100 pips. And if there are 1,000, 2,000, 3,000 pips, probably one can change the mindset from bullish to bearish, but not for small pips. And when you use such words, invariably, your sentiment seems to live long when compared to that of the market sentiment. So you find it extremely difficult to change your sentiment so quickly, and then the surprise is seen every time the news is released. So I take this opportunity to thank FX Trade sincerely and its team